Good morning. I'm Bob Hapanowicz, and I want to thank everybody for joining me today. It's a very interesting time, very interesting first 2 or 3 months of the new year of 2022. And we're going to discuss where we've come from over the last couple of years, what's going on right now. We're going to take a look forward as best we can into our crystal ball for you. H&A is a wealth management firm, and we serve financially successful individuals, families, and businesses all around the country. Today, we're going to attempt to look past the short-term news and focus on the intermediate to long-term fundamentals and hopefully answer your questions about what you should be thinking about, if anything, any changes you should be thinking about with your portfolio. So thanks again for joining me. Okay, I'm required to show you this screen. This is the disclosures. You see these on your statements every month. So now, since we've done that, let's go into the presentation. Let's start off by discussing the events leading up to this year, beginning with the pandemic outbreak in 2020. By all accounts and measures, these last couple of years will be prominently written into the history books for our children and grandchildren to read and learn. Pandemics don't occur very often, and this one, COVID-19, was one of the most severe in history. Let's hope that we continue to put the worst behind us as we work towards the new normal. As we exit the pandemic, there are changes in the way we work, play, and engage each other. And we can see that reflected from an investment management firm's perspective by the performance of various sectors of stocks. And we'll discuss those later. The COVID pandemic was an unprecedented shock across the global economy. The economic damage was met with an extraordinary global monetary response, which we're all familiar with. And as economies around the world have recovered and the impact of COVID-19 fades, these extraordinary levels of monetary stimulus are no longer necessary. And so we're going to see the active removal of them. Now, with these fiscal and monetary measures certainly help stave off a broader economic decline, they help drive the stock and bond markets higher. And today, there are headwinds, such as supply chain issues, high commodity prices, and tight labor markets that have led to inflation concerns. In some parts of the world, the COVID threat is still felt. For example, in China, the Chinese have a zero COVID policy. And so they are literally locking down cities. And that threatens to cause other supply chain issues. For example, with technology companies that rely on China's computer chips. Okay, this is a chart of earnings performance for the fourth quarter of last year and outlook going into this year, 2022. And last year was a phenomenal quarter with earnings up 31% year over year, one for the record books, so to speak. And looking forward, the expectation is for earnings growth of around 7%, according to FactSet and LPL. So by and large, still looking forward, things are growing. So what is causing the recent volatility? There are 3 themes or headlines in the news affecting the markets today. Of course, we're continuing to monitor the ceasefire negotiations between Russia and Ukraine. Oil prices continue to be volatile. They topped out at about $130 a barrel recently, just a few days ago. Today are down below $100 a barrel. And that's boosting hopes that energy prices will moderate somewhat. Of course, the other thing we're monitoring are COVID and the COVID lockdowns. And we talked about China a moment ago and their zero COVID policy. And that, again, could lead to adverse effects on tech supply chains. And the other potential theme that folks are talking about, at least if you're an economist, is that the Federal Reserve is raising interest rates, and they're doing that to combat inflationary pressures. Inflation is running at about a 40-year high, and the Fed, a couple of days ago, led by Jerome Powell, has indicated they're going to use every tool in their toolbox to control inflation, and over the next couple of years, bring it back to the target rate of about 2% per year. That's their Goldilocks target, not too hot, not too cold. And that has proven to be a very good number for economic growth in the past. So the confluence of all these events has raised inflationary pressures, as I mentioned, to the highest in several decades. And the markets are adjusting to the latest data. That's the proverbial kitchen sink being thrown at the markets over the last few weeks. And of course, COVID is here permanently in many ways, but the headlines today are dominated by the Russian war on Ukraine and the potential impact on energy, food, earnings, and inflation and supply chains. There is optimism. So despite all that kitchen sink stuff, there is optimism for a diplomatic solution, and that should be good for markets. But the path of least resistance, at least in the short term, it seems, could be more volatility given the inflation concerns mentioned earlier. and the possibility of worsening earnings revisions caused by the war. Higher food, oil, commodity prices, and other disruptions are felt by all of us and can affect earnings and therefore stock prices. So the market is digesting that today. There are tailwinds. So let's talk about those. In every market, good or bad, there's always headwinds and tailwinds. And the tailwinds are very positive for this market, and they are in focus. For example, stock buybacks. Companies are using this recent dip in the markets to buy back their own shares. It improves their balance sheets, it improves their earnings per share, and inevitably, in the majority of cases, the stock price will go up. For example, recently, Amazon announced a $10 billion stock buyback program and simultaneously a 20-for-1 stock split. Now, $10 billion, but the total authorized stock buybacks in the S&P 500 right now is $270 billion worth of stock. So that is authorized by the board of directors, and they are tasking management when the time is right to do that. And that is going to be a positive catalyst for the markets, we believe. It's also a very good sign that corporate America is confident in their future and confident in their company if they're buying back their own stock. So over the last few years, corporations have built up a war chest of cash on their balance sheets. Their balance sheets are the healthiest they've been in history. And that cash can be used for several things that are good for stock prices, other than just holding it in a bank deposit, which is earning not very much. So companies can buy back their own stock. That has been historically very good for stock prices. Companies can use that cash to grow organically. They can buy a building or build a building, hire people, build new widgets, build different color widgets. So that's growing organically. They can buy other companies. For example, locally, PNC Bank last year bought BBVA to expand their nationwide footprint. And then finally, companies can pay higher dividends. They can return that instantly to investors each and every quarter through higher dividends. All four of those historically have been very good for stock prices. So the Russian war on Ukraine and the markets are a topic. We see it in the headlines 100 times a day on the news. And wars or geopolitical events do cause volatility. COVID caused volatility a couple of years ago. And through the downdrafts though the downdrafts from geopolitical events are usually relatively short-lived, this downdraft, we can call it a correction, is deeper because the markets were in the process of adjusting to inflationary pressures that we discussed earlier. Stock market drawdowns from geopolitical shocks average about 5%. And of course, fears remain over diplomatic and geopolitical relations affecting our national interests, such as energy prices, labor costs, food prices, and supplies. Now, it should be noted that the U.S. economy's direct exposure to Russia is negligible, but we are in an interconnected global economy. So it's likely higher oil prices are here for a while. But in the case of the kitchen sink of these negative events, savvy investors might view these geopolitical events as opportunities to create wealth. For example, in the face of all the bad news, energy stocks, which bottomed and were left for dead a year or year and a half ago, recently hit multi-year highs. Defense stocks are also soaring today, while the glow of the fast money theme stocks with the shaky financials and no earnings are going in the opposite direction, in a risk-off moves. And that's because investors are favoring higher quality investments over those story stocks. It's helpful to take a look backwards, as it can help us in setting our expectations and guide our decision-making going forward. So I've got a couple of slides here for you. And this slide goes back to the peak of the markets in 2007 and covers the last 15 years, which covers a couple of bear markets. And there have been 16 bear markets in stocks since the end of World War II. It's about one every 5 years or so. And the average depth of those declines was something on the order of about 30%. But in the last 77 years, since the end of World War II, when the Standard & Poor's was about 31, the index now has gained to where it is today, about 43 or 4,400. So historically, the permanent advance of the stock market has prevailed over the temporary declines that you see on the chart. And we don't see any reason why that advance can't continue. So the market's natural ebbs and flows, we call it volatility, is normal and expected. Now, some investors may view volatility as the enemy. Our view at H&A is volatility can be harnessed and it can be our friend. At H&A, we work to identify and act with a disciplined process using the inevitable but natural ebbs and flows of the markets to our advantage. Our process is designed to capture excess returns by trimming and adding at the margins. Now, it should be noted that the dividend yield on the S&P 500 is about 1.5%. That's better than any bank deposit. In fact, there's some areas of the world where the dividend yield is closer to 3%. So if we're investing in stocks around the world, we're earning somewhere between 1.5% to 3% in just dividends while we're waiting for those stocks to go up. Here's another chart that our advisors have on their walls in their office, and we like to point at it because it discusses, about 100 years worth of data. And when I take several steps back away from this chart and look at the corrections, they all look about the same. The markets will take 2, 3, 4, 5 steps forward, 1, 2 steps back, 2, 3, 4, 5 steps forward, a couple steps back. But when I get up close, I can read all the writing on the chart and I can see what caused the volatility. For example, an oil embargo back in the 70s, or financial crisis back in 2008, or COVID just 2 years ago. So the takeaway, there's a different set of circumstances for each correction, but they all look about the same when we view them from a distance. Another takeaway, I'm very confident in predicting that there's going to be another market correction somewhere in the future. On average, the markets experience a 10% pullback about once a year. Historically, it's about double-digit rates of returns on the average year. At H&A, our belief is it's very difficult to successfully time the markets over the long term. That's why we don't go in stocks all the way and then out of stocks all the way. We're not aware of anyone having long-term repeatable success timing the markets. So therefore, to earn the full market premium that stocks have to offer, we believe you need to stay invested through the ups and downs. In other words, the best way to earn all the return that the markets have to offer is to remain fully invested in the amount of stocks that is right for you. Now, our process is to rebalance as opportunities present themselves. And that's the process of returning your portfolio within your stated risk budget to its target allocations. You get the benefits of buying the dips and trimming the gains. It's a conservative approach to managing your money. Here at H&A, we look for rebalance opportunities routinely through the year. And when an event like now is occurring, we drop everything to analyze the rebalance. What we've learned is that if we're patient and disciplined, we can work towards using that volatility to your advantage as we work towards adding excess returns by buying the dips and selling the rallies. Okay, this next chart is a historical look back at corrections, and we are in a correction. We entered a correction a week or so ago, 10 days ago. As I'm here talking to you on the 18th of March, 2022, and the market dipped below 10% from its recent highs in early January. And you can see from the chart that the red section, the red column in the middle, identifies the corrections and the depth of the corrections. And then to the right is a 1-year return and a 2-year return following the lows. And so you can see that you have a very, very good chance of experiencing extremely good returns following the correction. And we look at these charts because it can help frame our expectations of where the markets may be going. But bringing the conversation back to today, Russia is the dominant story. And along with COVID and inflationary pressures of tight labor markets and higher commodities, that's what's contributing to this drawdown or correction. And we think that savvy investors will use this opportunity and take advantage of it in a manner that's right for them and their portfolio. So the market is reacting and adjusting to the headlines and the possibilities of the fundamentals changing. But after the adjustment occurs, after the correction occurs, stocks have historically resumed their upwards climb. This next chart illustrates that we expect to have more volatility following a rise in interest rates. But that doesn't mean the bull run is over. In fact, in the previous 8 hiking cycles, the S&P 500 was higher a year after the first increase every single time. So what could trip up this bull run? Rising oil prices, coupled with higher interest rates. The Fed does face a tricky dilemma with crude surging, Russia's invasion, and it threatens to make oil even more expensive and therefore contribute to inflation. But there's another challenge facing investors this year, and that's the US midterm elections in November. And there's uncertainty around those outcomes. So in election years, market returns tend to be muted early in the years due to the uncertainty of the outcome of the elections and the subsequent effects on policy changes. But stocks typically post a strong rally at year end. So taken together, midterm years have seen the largest intra-year pullbacks. This quarter and the next 2 are historically some of the weakest of the 4-year presidential term. So back to inflation and interest rates. In the past 3 decades, the Fed has taken on 4 distinct rate hike cycles to cool off inflation, and none of those have been detrimental to equity markets. In fact, equity markets have moved forward every single time. And technology, which has seen wild swings this year on the prospect of faster rate increases, is typically among the best performing S&P 500 sectors during those cycles. But overall, leadership varies, with no sector outperforming in all 4 instances. The Fed said a couple of days that consumer confidence is expected to be stronger later this year as some of the headwinds begin to unwind. For example, supply chain issues should ease later. And a couple of days ago, again, the Fed said the U.S. economy is very strong, well-positioned to handle tighter monetary policy. In other words, interest rate increases, shrinking the balance sheet. So summarizing the above, so now we have tight labor, lower consumer confidence, and inflation worries. We don't expect a recession. In fact, the Fed is projecting we're going to have GDP growth of 2.8% this year. What was clear to me this past Tuesday in the Fed announcements is that they have a clear path forward to continue to tighten in response to this overwhelming concern around inflation. And they're going to use every tool in the toolbox to do so. Interest rate hikes will occur this year, probably next year too. And that's all in an effort to cool off inflation and get it back to the target rate of 2%. Again, that's the Goldilocks level. The economy is not too hot, nor is it too cold. They feel like that is the level where we can experience sustainable growth. So we expect about 7 rate increases this year and several more next year. And that is aggressive. The Fed meets every other month. They'll make their decisions at those meetings on whether to proceed, act more quickly, or slow down the pace. But they have a clear path. I think that's the biggest takeaway. And they're willing to use all their tools. That said, given the current conflict in Ukraine, there is additional uncertainty. There's upward pressure on commodity prices. Those were already impacted by COVID-19 related supply chain disruptions. So we may see a more sustained impact on economic issues as sanctions play out. And that probably will be the main source of risk in the short term. So what should we do in response to the volatility? Let's talk about what actions you might consider. My recommendation is you have a phone call or a meeting with your advisor at H&A. And you and your advisors should seek to answer the question, are my investments aligned with my long-term plan? I think we'll find in the majority of cases they probably are, but perhaps some things need tweaking. Your meeting with your advisor can satisfy the need to do something. And after a thorough review, you and your advisor can then decide on any changes, if any, and implement them in a well thought out manner. Because there may be consequences to the changes. For example, there may be a tax cost, or your cash flow may be impacted from interest and dividends. Now, we advocate and advise if anything is changing in your financial picture. For example, you're going to be retiring, or there's an inheritance, or you're going to move, or you're simply going to buy an island somewhere. Let us know at H&A as soon as possible so that we can make plans to assist you. Lastly, we don't believe that changes to the investment plan should occur necessarily just because of the war and the volatility in reaction to it. That's the market's natural ebbs and flows, the market's way of adjusting to the latest data. We have found that market timing is awfully hard to do correctly, so we advocate staying invested in the proportion of stocks that's right for you in your portfolio. I want to thank you for joining me today. Should you have any questions, please feel free to reach out.